of people have heard that before. They're like, what the froggy is a bridge loan, right? So I'll explain that briefly. It's not a long video. It's actually pretty short. And my intentions are to just update those who don't know and further educate, I guess, those who do know. Some people have heard of bridge loans, but they don't quite know what it is that they do. And it's just like what it sounds like. It's the gap, right? So when you're borrowing money, okay, and you're obviously taking on a major project, you don't do a bridge loan for the purchase of a home. So when I'm talking bridge loans, we're talking about something that's major. You're building an investment property, multifamily property, commercial property, something along those lines. Those are the intents of taking on a bridge loan. You would hear for something like, or you're taking on a major project of some sort, of some magnitude, that the funding that you need up front to get everything moving forward, maybe you don't have all your collateral up front, and then timeline wise, right, you need something to happen sooner or later, or maybe the deal will fall apart. Maybe it's, a 1031 exchange, which is, an entire deal where you don't pay taxes, right? That's, I guess we'll throw that golden nugget in there. On a 1031 exchange, you're going from one investment to another investment of greater value, okay? And the money doesn't go to you in that process. And there's more details involved in something like that. But that's the way that you continue investing, moving your money from one thing to the next, without it actually going to you, and you're going in an upwards direction in a certain timeline, and it all has to be investment property. It cannot be anything personal. It cannot be something that you homestead, things of that nature. But anyway, back to the barn. Okay, so a bridge loan. Essentially, what I want to cover is what is a bridge loan. So I'm going to define that for you. Okay, when to use a bridge loan. So essentially, it's timing. It's like I said before, and I'll go in a little more detail with that. And I actually have an example here that I'll read to you guys. And then how it works. All right. And then a bridge loan versus a traditional loan. Just so you kind of understand the meat and potatoes of it all. If you are, in fact, an investor and you're looking to move forward, and you're just like, you know what? Maybe you were just Googling just now, what is a bridge loan, right? And so you see my video and it's, here's a bridge loan. Okay, so without further ado, okay, what is a bridge loan? A bridge loan is a short-term loan used until a person or company secures permanent financing or removes an existing obligation. Okay, it allows the user to meet current obligations by providing immediate cash flow. Bridge loans are short-term, typically up to a year, and they have relatively high interest rates. So I defined it for you. We've all seen ridiculous interest rates. We've all seen really low interest rates. Okay. In this case, bridge loans are probably real similar to like a hard loan. If you've heard of a hard money loan, that's when you're borrowing money from someone, right, or group, entity therein, and they're like, hey, we need our money back in 6 months, right? And we're going to hit you with 10%, 12% interest, right? And sometimes there's an early payment penalty because they want to see it accumulate up to a certain interest rate, because if they're unable to make their interest because you paid them back too soon, then they really didn't get what they wanted out of it. Does that make sense? Right? And then so they'll hit you with that early payment penalty. What else is crazy about those? Typically they want your firstborn. No, I'm just kidding. No, but it is that, the situations are, but here's the great thing to it. The great thing is, hey, the approval is real quick. It's a drive-by appraisal, just show me the location. What kind of numbers is it bringing in? Okay, it's bringing in that. The place actually exists. Okay, what do you have for collateral? They want to see what kind of collateral you have, what kind of cash you have on hand in case they need to get their money back somehow, right? So that's the hard money. So bridge loan, essentially there's a gap in what you need to achieve in a deal, right? So key takeaways with a bridge loan. So short-term financing used until a person or company secures permanent financing or removes an existing obligation. I mentioned that briefly, right? So essentially, let's say you know you have other funding coming, but it's not going to land on time. And this deal, like I mentioned, a 1031 is timeline. In this particular deal, not necessarily that it is a 1031, but on this deal, what you need to do is you have to beat the clock, right? So you want to get everything done so that you can move forward with the next line item or agenda in your project that requires that loan, that acquisition, whether it's a bridge loan just to achieve the land purchase before you start building and then getting all the environmental studies, geological studies, and so forth done, soil tests, all these different things that are required when you're breaking ground, okay, and then you're hit with all these other steps moving forward, right? Another thing is bridge loans are short term and typically up to 1 year. I've seen 2-year bridge loans, but yes, they want their money back quick because all they did was fill the gap until you need it. So what is the gap? I didn't even mention the gap. It's not the store, okay? The gap is, let's say you got, I don't know, 85% coverage on the loan for an acquisition, right? So that lender or group or whatever it is, like, I'll give you 85% of whatever it is that you need for that project. So you're missing that remaining amount, right? What is that, 15%? So where am I going to get that? That's the bridge. So then you get the bridge loan. It covers that missing amount. Now you're still going to need your closing fees and all that for the bridge loan. So the bridge loan is going to cover all of that initial closing stuff and the gap and all of that for the first loan. And now you have a smaller collateral and closing and all that for the bridge, right? And you fulfill that, knowing that in less than a year, I mentioned as much as 2 years, you're going to have the big loan. And the big loan is because now you're able to shop it out to a group, or you already have a group that's really interested and they see your entire project and see it's funded. And you're like, hey, I'll sell this to you, or I need a loan for this much to cover this entire nut. We'll do this with you at this rate. We'll pay all of them off, get them out of the way, like it says, removes existing obligation, right? And then you move forward with a new party, a new team at the table, right? So that's the whole purpose of that. These types of loans are generally used in real estate, right? You do it for business acquisitions too. I've seen that. But in this case, this is strictly, okay, for my example that I'm giving you is real estate, okay? I have a story here, and the story is an example of a bridge loan when Olean America Corporation wanted to purchase the Sony building in 2016. It took out a bridge loan from ING Capital. The short-term loan was approved very quickly, allowing Olean to seal the deal on a Sony building. Okay, the loan helped to cover part of the cost of purchasing the building until Olin American secured a more permanent long-term funding. The bridge loans provide immediate cash flow, but come with high interest rates and are usually require collateral. Okay, so that's what I wanted to explain to you guys. And then real quick, because I don't want to spend a lot of time on this, this is advanced stuff, and if you're watching this video, it's because this is the level that you're on, right? If you're not, you already left the video. That's because we're well above you, dude. The sky is just for staring at, dude. We're well above that, and we're reaching for the freaking next galaxy. You got me? So, bridge loans versus collateral. Collateral. Ooh, I'm already thinking about moving forward and like making deals happen. I'm thinking about collateral and what we got to do. Sorry, lost pace. Bridge loans versus traditional loans. Bridge loans typically have a faster application, approval, and funding process than traditional loans. However, in exchange for the convenience, these loans tend to have relatively short terms, okay, high interest rates, and large origination fees. That's the fees I was talking about. So to close it all up in the bag, they're going to want a little more. Generally, borrowers accept these terms because they require fast, convenient access to funds. So they want to get it done quick. They're willing to pay the high interest rates because they know the loan is short term and plan to pay it off with low interest long-term financing quickly. Okay. Additionally, most bridge loans do not have a early repayment penalty, right? And this article was courtesy of KW Commercial Capital Markets gentleman Peter Charlin Jr. Want to pay respect for providing great literature when I come across some great notes and information that help me do what I do. I definitely want to pay respect. I'm a huge reader. Got books sitting here and there. Let's Take the Stairs, and the other one, Dave Ramsey. Which one is this? Total Money Makeover. Great book. Just redirecting your funds, pay yourself first, that kind of thing. So that's it in a nutshell. Just wanted to knock that out of the box for my advanced people that are in commercial doing major real estate deals. Maybe they need to sharpen up on exactly what a bridge loan was. There it is. I gave you your examples. I couldn't have made it any clearer and simple to understand. I'll drop some more knowledge, some jelly beans here and there so you guys are able to get out there and make that money. See you guys. Let's get out there.